Welcome back to the Deep Dive. Today, we are opening a massive, and I think pretty sensitive, file on a market paradox, that is.
Well, it's so extraordinary, it almost has to be a cover-up.
It really does.
We're talking about silver. And specifically, this global consensus that's been building among market analysts that its price isn't just low, it's being deliberately, actively suppressed.
And this is really a detective story. That's the best way to look at it. We have to look past the ticker tape, the daily price action, and into the hidden motives of some very powerful institutions.
So our mission today is a deep dive into this mystery. Why does silver, which is by any metric a critical strategic metal, why is it trading for a price that just seems to defy the laws of supply and demand?
We're going to uncover the motives, the very sophisticated methods they use, and what we believe is the inevitable and probably violent end game of this whole price cap scheme.
Okay, let's just jump right into that central mystery, because it's a contradiction that really should be keeping people awake at night. I mean, engineers, military planners, investors.
One. For you listening, just ask yourself this basic question. Why does the most electrically and thermally conductive metal in the universe, the one you absolutely need for AI, for solar energy, for every missile, why does that metal trade for less than half the price of a decent smartphone?
It's an economic absurdity. It really is. When you look at the fundamental data, and we have stacked the sources on this, global demand is at an all-time high. It's surging.
Right. Driven by industrial use.
Exactly. And at the same time, supply from mining, it's falling, or it's stagnant at best. We are consuming way more silver every year than we are digging out of the ground.
And that deficit is being filled by draining the stockpiles that are already above ground.
Right.
So in a truly free market where demand is skyrocketing and supply is falling, the price is supposed to balance that, right? The price should be going up.
It should be, absolutely. It shouldn't be sitting where it's been for years, just hovering in the $20, $30 range. If this were any other commodity, based on scarcity alone, we should be looking at $100, maybe $200 an ounce.
Easily. That price would encourage new supply. It would curb some of the non-essential demand.
But it hasn't happened. And that's the verdict of our investigation right here at the start. The silver market is not free. It is managed. The low price you see on the screen isn't an accident. It's an engineered feature of the Western financial system.
A feature designed to serve some very powerful strategic goals. So this isn't just about market dynamics. We're talking about a massive financial cover-up.
We are. And this suppression, this engineered low price, it achieves multiple goals at once. It supports the US dollar, and it quietly subsidizes the biggest defense and tech firms in the world.
So we need to look at this not as some fringe theory, but as, what, economic statecraft.
Institutional economic statecraft. And history teaches us that all price control schemes, they are destined to break. Whether it was the Soviets with grain or the U.S. fixing gold in the 60s.
They always fail eventually.
Always. And when this one breaks, the price movement won't be a trickle, it'll be a flood. A violent flood reflecting decades of pent-up economic pressure. We've identified 4 key pillars holding this whole thing up, which explain exactly why they are so incentivized to hide silver's true value.
Okay, so let's get into those 4 pillars. Let's start with the one that affects everything, the confidence in the entire global financial system, the dollar defense.
Right. So what's fascinating here is that the U.S. dollar's power, its hegemony, it's based entirely on confidence. Nothing else.
It's a belief system.
It is, and historically, structurally, psychologically. Gold and silver are the ultimate competitors to the U.S. dollar. They function as the anti-dollar.
They're the escape hatch, the exit valve when people lose faith in paper currency.
Exactly. They act as this real-time, very inconvenient report card on the Federal Reserve and the financial health of the country.
So when gold and silver prices shoot up, it's a public vote of no confidence. It's a flashing red light saying, hey, there's inflation here, or the system is unstable.
Precisely. And it signals a lack of trust in the currency itself. Now, just consider the psychology of it. Imagine if silver were suddenly allowed to trade at its real scarcity value. Let's say $150 an ounce.
Okay.
That wouldn't just be a number on a trader's screen. It would dominate the front pages of every newspaper in the world. It would be this stark, undeniable signal that the dollar has just been massively devalued.
And you'd trigger a stampede. People, institutions, everyone would start dumping dollar assets, especially things like treasury bonds.
They'd rush into real physical assets. The sources we looked at are clear on this. The speed of that capital flight could seriously destabilize the bond market. You could trigger a sovereign debt crisis.
A total collapse of confidence in U.S. debt, and by extension, the dollar.
And that is the strategic goal of the suppression, to keep that crucial canary in the coal mine quiet, to keep it comatose if possible.
So the financial powers, the central banks, they have an existential interest in suppressing that signal.
An overriding interest. If the dollar is going to stay the world's reserve currency, then its competitors, especially the ancient monetary metals, they have to be made to look weak, irrelevant, stagnant, no matter what the physical reality is.
Okay, that makes perfect sense. You control the narrative of a dollar's health by controlling the price of its rivals. But let's connect that monetary motive to something more tangible, something critical to global power. The defense budget.
Yes, the missile subsidy.
It's a missile subsidy.
This is where we pivot from, high finance to raw military strategy. Silver is not just some tertiary metal. It's a strategic metal. It's indispensable.
Why? What makes it so special?
It's this unique combination of conductivity, thermal resistance, its malleability. You just cannot fight a modern high-tech war without vast, reliable, and cheap quantities of silver.
Okay, so give us some of the hard numbers, the specific applications. We're not talking about jewelry here.
No, not at all. We are talking about massive strategic consumption. Take the defense sector. Every single Tomahawk cruise missile contains about 500 ounces of silver.
500 ounces. In one missile.
In one missile. For its guidance systems, circuitry, battery components, every advanced fighter jet, every satellite, every torpedo, they all rely on high-quality silver contacts. If that contact fails, the weapon fails.
So the cost implication here is just enormous.
Mm.
If the free market took over and the price went to, say, $100, $200 an ounce.
The cost of national defense would explode overnight. It would blow up the Pentagon's procurement budget.
You would make the next generation of weapons unaffordable.
Exactly. The sources confirm this. By suppressing the price to, say, $25 instead of $200, the financial system is providing a hidden, involuntary, multi-billion-dollar subsidy directly to the military-industrial complex.
So the Raytheons, the Lockheeds.
All of them. Their input costs, the actual metal they need to build the tools of power, are kept artificially low by financial engineering.
And it goes beyond just military hardware, right?
Yeah.
This subsidy supports Western tech dominance in general.
Oh, absolutely. Look at the green energy transition. Solar panels are a colossal and growing source of demand for silver.
So keeping silver cheap keeps the cost of solar panels down.
And Apple products. And Tesla batteries. And 5G infrastructure. It's a subsidy for the entire tech sector.
It's brilliant, but incredibly cynical. So here's the punchline for you, the listener. Who pays for this subsidy?
That's the key question. It is a direct wealth transfer. The cost is borne primarily by the mining companies, the producers, Mexico, Peru, Chile. They're forced to sell their finite strategic resource for a fraction of its true value.
And by retail investors, people who hold the asset while its price is being deliberately held down.
It's a mechanism that forces the global producers of a raw material to involuntarily subsidize the strategic technology consumers in the West.
I have to push back a little here, just playing devil's advocate. The sources point to this being a rigged game, but isn't it just smart statecraft? Wouldn't any major power want its input costs to be low?
That's a fair point. But the distinction is in the method. If the U.S. was just negotiating better contracts, that's procurement. But what we're seeing, and what we'll get into, is active, manipulative intervention in the paper market.
Okay.
That is not a free market operation. And that leads us perfectly to the third pillar. Sheer, uncomplicated greed. Bank profit. That's what provides the muscle for the suppression.
The bullion banks. We need to talk about them. Institutions like historically JP Morgan and others, they don't just facilitate trades, they manage the market. And critically, they hold massive short positions.
And when we say massive, we're not talking about a small hedge. We are talking about huge leveraged bets that the price will not rise. And this behavior is all tied to something called the carry trade.
Okay, let's break down the carry trade because this is the engine of their profit and their motive to manipulate.
It's actually pretty simple. The banks can borrow silver physical metal or just paper claims on it at extremely low interest rates, often near zero. They immediately sell that borrowed silver into the market for cash. Then they take that cash and invest it in something with a higher yield, like a U.S. Treasury bond.
So they're just pocketing the difference in the interest rates. They borrow at zero, invest at, say, 4%, and that's their profit.
That's their profit. It's small, but it's guaranteed, provided one critical condition is met.
Let me guess. The price of silver has to stay flat or go down.
Exactly. The carry trade is only profitable if the price of silver doesn't go up. Because remember, They have to eventually buy that silver back to repay the loan.
So if the price spikes, their short position gets destroyed.
Absolutely. A big move up in silver would instantly erase all their accumulated profits from the interest rate spread. It could cause catastrophic losses.
So they have a direct, overwhelming financial incentive to cap every single rally. They have to.
They are structurally short the metal. They are not philosophically opposed to silver. They are financially exposed to a rise in its price. So the price must be managed, otherwise their whole trade structure blows up.
Okay, so we have the bank greed, we have the monetary defense, the military subsidy. It all starts to form a pretty clear picture.
But there's one last pillar, and it connects this whole domestic financial operation to global power dynamics. Geopolitics.
Resource imperialism.
That's what it is. Look at the consumer-producer divide. Who digs silver out of the ground and who uses it in their factories?
The producers are nations like Mexico, Peru, China, Russia, largely the global south and east.
And the primary consumers are overwhelmingly the USA and Europe, the West.
Right. And in a world of commodities, high prices mean wealth transfers from consumers to producers.
Always. If oil prices are high, wealth flows to Saudi Arabia. If copper prices are high, wealth flows to Chile. And that wealth buys them economic leverage. It buys them sovereignty.
So conversely, low commodity prices keep those resource-rich nations, well, poor, and dependent on Western financial institutions.
Dependent on loans from the IMF, the World Bank, they're forced into debt even though they're sitting on vast mineral wealth.
So the power dynamic is clear. If Mexico could sell its silver for $150 an ounce, their need for Western loans would.
It would vanish. It would grant them genuine economic and political independence.
So suppressing the price of silver is a tool for maintaining the geopolitical hierarchy.
It's a critical tool. It keeps resource-rich nations poor and indebted, and it allows the resource-consuming nations to maintain their technological and military advantage at a huge discount. It is, by definition, resource imperialism, just disguised as a stable market price.
So we have established the why, a powerful combination of dollar defense, the missile subsidy, bank greed, and geopolitical control. Now let's get into the how. How do they actually do it?
Right. How do they keep this high-demand metal so cheap against all the physical pressure? It all boils down to creating a fiction, a paper fiction.
And the weapon of choice is the paper futures market.
Yes. The primary tool is the massive, almost unregulated leverage you can get on the paper futures market. The COMEX in New York is the main arena for this. Its only real purpose in this context is to create an illusion of infinite supply.
An illusion because the volume of paper silver traded, it just dwarfs the amount of actual physical silver in the vaults.
It's not even close. We're talking about paper claims that can exceed the physical stock by ratios of 300 to 1, sometimes even 500 to 1.
So banks are selling billions of dollars of paper silver that they just don't have.
And have no credible way of ever delivering. This paper leverage is their core mechanism of control. So when real physical demand starts to push the price up,
The market tries to find the real price.
exactly. The banks use this paper leverage as a weapon. They just flood the market with these unsubstantiated paper sell orders.
And the timing of these dumps is suspicious, to say the least.
The timing is the smoking gun of manipulation. These massive paper dumps almost always happen during what we call low liquidity hours.
Like 3 in the morning, New York time.
Exactly, 3 or 4 a.m. Eastern Time, when North America and Europe are asleep and the market is dominated by algorithms.
And they choose that time because a big sell order will have a much bigger impact on the price.
Right. An outsized impact. The goal isn't to make a profitable trade. The goal is to smash the price. By dumping hundreds of millions of dollars of paper contracts into a thin market, they can knock the price down instantly.
And that scares off retail investors. It triggers stop-loss orders. It's psychological warfare.
It is. It's designed to shake out the weak hands and create a technical signal of weakness. The technique even has a name among traders: painting the tape.
They're creating a false narrative that the dollar is strong and the metal is weak.
A narrative that happens to perfectly protect their carry trade. They are fighting physical scarcity with overwhelming paper fiction.
And there's an even more specific technique they use, one that's led to huge regulatory fines. It's called spoofing.
Yes. Spoofing is probably the most explicit, I would say, criminal example of manipulation. It's a way to rig the price without ever having to commit to a trade.
Okay, so walk me through it. If a bank wants to stop a rally, what do they actually do on their screens?
So the price of silver starts to tick up. They will instantly place a massive multi-billion-dollar sell order on the books.
A huge wall of contracts.
A colossal block, far more than anyone would reasonably sell at that moment. And here's the key. They place that order with the premeditated intention of canceling it moments later. It's a fake order.
So the market just sees this giant wall of supply that's about to hit.
Exactly. The algorithms, the high-frequency traders, they see this wall of supply, and their logic immediately interprets it as a massive, unexpected supply glut. So they sell, it creates a false panic.
And before that huge fake order can actually be
They
executed.
cancel it. They never had the metal, they never intended to sell, they just wanted to scare everyone else into selling first to create that downward momentum.
It's pure manipulation. And by doing that, they achieve all their goals at once.
They do. They maintain the price cap for the dollar defense and the missile subsidy, and they often get to cover their own real short positions at that artificially lower price, which locks in their profits. It's phantom supply used to keep the market permanently capped.
But there's this fundamental tension here. You can't just keep printing paper claims on a physical thing forever without someone eventually asking for the physical thing.
And that is the fatal flaw. History gives us a perfect, irrefutable example of why this entire system is destined to collapse.
Okay, so we've covered the crime and the methods. Let's talk about the consequence. Because these price-fixing schemes, they always fail.
They succeed until they fail. And when they fail, it's spectacular. It's violent and it's sudden.
And the best historical analogy we have for this is the London gold pool failure in the 1960s.
It's the primary analogy. It proves that these schemes are self-destructive because they require you to spend a finite resource, the physical metal itself.
So this was an actual conspiracy, right? It wasn't a secret.
No, it was an acknowledged conspiracy of 8 Western central banks led by the U.S. Fed. Their goal was monetary defense, just like today. They wanted to keep gold fixed at $35 an ounce to maintain confidence in the Bretton Woods system.
So if gold was stable at 35, the dollar, which was pegged to it, also looks stable.
That was the idea. And
Yeah.
their mechanism was exactly the same as the silver suppression today, just, more analog, without the computers.
So when the free market price of gold tried to go above 35,
The pool members would sell physical gold from their vaults, thousands of tons of it. They were using their sovereign reserves as ammunition to physically cap the price.
and it worked for a while.
It worked for about 7 or 8 years. But here's the fatal flaw. They were selling a finite commodity into infinite demand. The market eventually realized that the central bank vaults were just running empty. The physical drain was unsustainable.
And I found it fascinating, the sources, that the breakdown wasn't caused by one single event. It was this slow, growing loss of confidence.
That's right. Once the smart money, other central banks, wealthy funds, once they understood the pool was running out of ammunition, the whole system was doomed.
A run on gold began.
A massive run. They couldn't sustain the outflow of physical metal anymore. And in March of 1968, the London gold pool just dissolved spectacularly.
And the aftermath is the critical lesson for us today. Once the suppression was broken, gold was free.
And it went on a violent revaluation. Over the next decade, gold soared from $35 an ounce to $800, a massive explosion that punished everyone who trusted the official price.
So the silver suppression today is London Gold Pool 2.0.
It is. The motives are identical dollar defense, geopolitical stability. The mechanism is more modern, with futures and spoofing, but the vulnerability is exactly the same: physical scarcity. They will eventually run out of the ammunition needed to maintain the lie.
Okay, to help visualize this pent-up pressure, we have the beach ball analogy.
Yes. The idea of suppression isn't just letting the market be. It's an active, violent fight against economic reality. It takes constant energy.
So imagine you're in a swimming pool, holding a big beach ball completely underwater.
Right. The beach ball is the true market price of silver. It wants desperately to rise because of all this intense demand. And you can hold it down, but it takes constant, significant effort.
And that energy in the financial world is the endless creation of paper contracts, the spoofing, and the occasional sale of real metal to keep up the illusion. They can never rest.
They can't. They have to sell into every single rally. But eventually, one of two things happens. Either they get financially tired of fighting the market, or, and this is the key from the London gold pool, they run out of physical material.
They run out of the actual beach ball.
Well, they run out of the strength to hold it down. And when they're forced to let go, the beach ball doesn't just gently float to the surface.
It rockets into the air.
Violently. That volatility is what makes this endgame so fascinating. The release will be fast and aggressive because it's releasing decades of stored energy.
All the pressure that should have been released in a gradual price rise over 40 years.
Will be released in a few weeks. It will catch almost everyone completely off guard.
So we have the motives, the methods, the historical inevitability of failure. The crucial question is, how close are we? How do we spot the 1968 moment for silver?
The lesson from the gold pool is that even the biggest paper scheme needs physical metal to work. You have to be able to at least credibly claim you can deliver an ounce.
So the countdown clock isn't the paper price on the screen. It's the physical inventory in the vaults.
That's it. The tipping point is when the suppressors can no longer credibly claim they have access to the metal. And we are rapidly approaching that 1968 moment because the vaults are being drained.
Specifically, the registered inventory. For you listening, you need to know the difference between eligible and registered.
Right. Eligible metal is just stored in a COMEX vault. It's owned by someone, but it's not for sale. Registered metal is the silver that is cleared for immediate delivery against a futures contract. That's the bank's available ammunition.
So when the registered inventory drops, their ability to fight is dwindling.
It's dwindling, and the sources point to one key mechanism that's accelerating this drain: the Shanghai arbitrage.
Okay, this is where it gets technical, but it's crucial.
It is. The Shanghai arbitrage is a self-correcting market mechanism. The price of silver is almost always higher in the physical markets of Asia, especially Shanghai, than it is in the paper markets of the West.
Because the East values physical metal, and the West is playing a paper game.
Exactly. So savvy traders can exploit that price gap. They buy the cheap paper contract in New York. They demand delivery of the physical metal.
Which forces the bullion bank to cough it up.
It does, and then those traders immediately ship that physical metal to Shanghai and sell it for a significant guaranteed profit.
And this arbitrage is literally bleeding the Western vaults dry.
It is. Every single ounce that leaves a COMEX vault and goes east is one less ounce the banks can use to suppress the price. It's the market's way of correcting the injustice, forcing the paper system to surrender its physical stock.
It's a slow, relentless physical war of attrition.
And the end of that war is stark and unambiguous. The game ends when the physical inventory hits a level so low that everyone with a paper contract realizes delivery is impossible.
As we said, they can print unlimited paper contracts. They can't print the metal.
So once that ratio of paper claims to physical metal reaches a point of absurdity, trust evaporates instantly, just like in 1968.
And the final moment will be a delivery failure. The moment the COMEX can't deliver physical silver to someone who demands it.
That's the moment the price discovery mechanism shifts fundamentally and instantaneously.
And that failure signals to the whole world that the price in New York is a fiction.
It's a synthetic construct, and control immediately moves from New York, the paper market, to Shanghai, the physical market. That is when the dam bursts.
And that shift is what transforms this whole situation from just a technical discussion into a once-in-a-generation opportunity.
For the astute listener, yes.
Okay, so this whole deep dive has been a detective story, exposing this cover-up. But the verdict for you, the listener, is actually simple. The low price of silver shouldn't be seen as a problem. It should be seen as a gift.
It's a subsidy provided directly to you by the banking cartel. They are keeping the price artificially low, allowing you to accumulate a real strategic asset on the cheap.
So let's talk about the smart money playbook, how you can position yourself for this inevitable breakout. There are 4 steps.
Right, 4 steps, and it requires discipline and patience.
Step 1, accumulate, don't complain. Use this period of suppression to buy real physical silver. Coins, bars, trusted funds. Yeah, you're getting it for pennies on the dollar relative to its true value.
And when you see the price smash down, you have to view it as a discount opportunity, not a reason to panic.
Step 2, ignore the paper volatility. This is crucial. When they deploy those 3 a.m. paper smashdowns, do not panic sell. That is a predictable trap designed to shake you out.
If the fundamentals, demand up, inventory down, are still in place, you have to ignore the noise of the paper price. Focus only on the physical reality.
Step 3, watch the inventory, not the ticker. Your countdown clock is the vault levels, specifically the registered inventory. It's the only metric that really matters.
As long as those inventories are dropping, the price explosion is getting closer no matter what the paper price does today.
And step 4, be patient and prepare for velocity. The London gold pool lasted 8 years. This silver suppression has lasted for decades. The end is approaching, but the final battle will be volatile.
The patience required to wait for that beach ball to finally pop, it's going to be severely tested. But the payout will reflect 40 years of accumulated pressure being released all at once.
So the powers that be are holding the beach ball underwater right now, expending enormous financial and political will to do it. Your job is simply to understand the game, hold your physical position, and wait for them to run out of ammunition.
Because history shows, in every single instance, the future belongs to the owners of real physical assets when the paper promises finally fail.
Okay. So we have completed our deep dive. We've exposed the 4 pillars: monetary defense, the missile subsidy, bank profit, and geopolitical control.
We've detailed the mechanics of the manipulation, the historical precedent for its failure, and how the dwindling physical inventory is the definitive countdown clock.
We know they're holding the beach ball underwater.
So here is the final provocative thought for you to explore. Given that this whole suppression scheme requires the bullion banks to maintain a continuous, massive, leveraged short position, a huge bet against the price rising, what does the global financial fallout look like when those decades-long short positions finally explode?
This isn't just a commodity rally we're talking about.
No, this is a potential institutional solvency event. The banks who maintain the lie will be forced to cover their liability all at the same time. That could trigger a chaotic unwind across the world's major financial institutions, creating volatility that could rival some of the greatest financial crises in history.